China's stock market plunging 6.1% today despite the government's persistence to stabilize it, or persistent involvement, I should say, to stabilize it. The overseas plunge is causing the Dow to slip a bit here, but just recovering a bit, down just 25 points. A lot of questions, though, about the future of our markets and the future of our economy. Of course, we're going to be getting some Fed minutes very soon this week, and the Fed is meeting in September. Janet Yellen is expected to raise rates a quarter point. Joining me with his perspective on the economy and the Fed, the former chairman of the Federal Reserve himself, Alan Greenspan. Good to see you, Chairman Greenspan.
My pleasure.
So let's start first with your sense of the economy. How would you assess it right now?
I would say it's extraordinarily sluggish. It's fundamentally being suppressed by a very low rate of increase in productivity, in fact, close to zero. And you can't get more than a 2% growth rate out of those numbers.
So why is it that, we're in an environment where money's so cheap? I mean, people can borrow for basically next to nothing, and yet we're not growing more.
Well, the basic problem is that we're not getting any capital investment that significantly adds to the growth in output per hour. In fact, the best way of looking at this whole process is the fact that the sum of gross domestic savings in the United States and entitlements has been a constant relative to GDP for 50 years. And if that is the case, then it means that for every dollar increase in entitlements, you lose $1 of savings.
In other words, we got a real entitlement problem on our hands?
We've had an entitlement problem for years because entitlements have been growing under the administrations of Republicans and Democrats close to 10% a year for a half century. We're finally at a point where it is essentially crowding out the
But is
really
this the reason, Chairman Greenspan, why companies aren't spending? I mean, you say we've got this lack of capital investment. Why is there such a lack of capital investment given that money's so cheap?
Well, basically because a goodly part of what is invested is the savings of people, and we're getting less and less of that as the consumption involved in entitlements year by year eats up the savings. You cannot have investment without savings, either borrowed from abroad or hopefully domestically.
There are a lot of people that are very concerned about this low interest rate environment. They say, to your point, you're not seeing enough investment by companies in things like infrastructure and people, but you are seeing a lot of investment in the way of, say, mergers with one company gobbling up its competition. As we well know, that doesn't necessarily, it may improve efficiency and productivity, but it doesn't really create jobs in the here and now. And there are people, Chairman Greenspan, that are very concerned we're actually potentially looking at an asset bubble thanks to these low rates. I want to share with you something that Carl Icahn said to me just recently on the program.
In financial markets, I believe that there really is a bubble brewing, and interest rates now are at a low that in the history of the Federal Reserve, they've never been held down this long, and I don't think anyone will deny that it's uncharted territory, and it could be very, very destructive.
Chairman Greenspan, does Carl Icahn have a point?
He does. Remember this, that normal interest rates for a reasonably good debt have always been in the 4 to 5% annual rate going back millennia. We have data going all the way back to ancient Greece, and interest rates were not all that significantly different then than now. And we have daily data going back to 1694 with the Bank of England. The reason that this is a critical issue is it's telling us that the interest rates we're looking at in history is probably almost certainly built into human time preference. It's inbred, and that means we have pressed the interest rates well below normal for a protracted period of time.
And what's the danger in that?
The danger is that they will begin to come up to where they've always been for millennia.
And what does that do to the markets when they do?
Not good. Remember what a bubble is in the bond market. We tend to think of stock market bubbles as very substantial price-earnings ratios. Well, if you turn the bond market around and you look at the price of bonds relative to the interest received by those bonds, that looks very much like the usual spread which would concern us if it were equities, and we should be concerned.
So does this mean you're worried about a bond bubble right now in fixed income, in bonds?
I think that there are two possibilities. Either we move slowly back to normal, or we do it in a fairly aggressive manner. History tells us it's the latter which tends to be more prevalent than the former.
So as an investor, if you were an investor in this environment right now, would you be exercising caution?
I wouldn't be answering your question.
Meaning? Why not?
Because I don't talk about my individual investments, and I don't talk about the Federal Reserve policies directly.
That's fair. But overall, as you look at a market right now that has sustained itself on, some people have criticized it sort of a sugar high, has sustained itself on these zero interest rates. I think the big question in everyone's mind is whether or not this market is able to continue moving higher if the Fed decides to raise.
Well, I think the best way of looking at this is to recognize that the price-earnings ratio is really statistically made up of two forces. One is the equity premium, which actually is a little out of line now, but not materially so, plus the level of riskless interest rates. It's there that the basic problem arises, because for whatever reason, whether it's the Fed moving or the market moving itself, bond prices fall. You begin to get very significant downward pressure on stock prices. And there is where the real problem lies as far as equities are concerned, is that it cannot be disassociated from the fact that interest rates are historically too low and will have to move higher eventually.
Yeah, at some point. At some point. Well, Chairman Greenspan, it is wonderful to have you here. Thank you for joining me.
It's been my pleasure.